Okay, listen, welcome everyone to another investment chat. I am very happy to have someone I've known for quite some time, Ben Laidler, who's the founder of Tower Hudson. Ben and I have known each other for a long time, and I was on the buy side. I was a client of Ben's back in UBS days, and then going through the HSBC days. Ben has been doing investment strategy for a very long time in emerging markets and then globally. One thing I like about what Ben does is he early on used a lot of data and informatics to really show what he's trying to get across, and I think that's why he had a very strong following. So Ben, I certainly want to thank you for coming to join us here to talk about global markets.
Great, thanks Tom, and hi everyone. Appreciate you all taking the time out of your day to come and listen to what we're talking about.
So Ben, yeah, certainly let's jump right into it. The elections obviously on everyone's mind. We just had the amazing rally yesterday, and I think certainly one of the things people want to know is is the rally over? How should I position myself? So talk about what are your thoughts about moving past? I mean, forget about all the noise, but let's say the elections are now passed. We're going to have a new president. We're going to have a lot of new congressmen.
Yeah.
So talk to us about what your thoughts are there, and I'll put up your slides. So if you want to refer to them, that's
right. Yeah. So I mean, we've been calling for a fourth quarter rally, which we had a sort of bit of I would call it a consolidation in third quarter. You can see it there on the chart, and really I think that was setting us up for what we've started to see now, which is this sort of fourth quarter rally. And I think what's driving this is investors are pretty cautious. We're through the election, which I think obviously generate a lot of uncertainty, but we're now through that, and you have these cautious investors that are now looking forward into this sort of year ahead of 2021, where I think this growth outlook is looking very strong, and I think this outlook is supported by the resilience of the recovery that we've seen so far. We have a bunch of catalysts out there, one of which we began to see yesterday, in terms of vaccines and this sort of lower lockdown sort of outlook. Maybe we get some more fiscal stimulus, and I just don't think investors are really positioned for this. And to your point, I do think there's a big sort of rotation trade in here as well. Not only do investors need to sort of own more equities than I think they do, but they also need to own sort of slightly different equities than they've owned for the last sort of 6 months. So I think there's a rotation trade of intercyclicals in there at the same time. And I think the election's been really important, not only because we've got this sort of benign sort of gridlock result of sort of the tax and regulatory risks of maybe you put to the side somewhat. We've got sort of more multilateral sort of international outlook and a sort of weaker dollar, but quite a lot of the risks coming into this we priced quite a lot in. I mean, the market had come down, the VIX had gone up a lot, and so we've ended up with not a bad political result. But I think as importantly, just two other quick things. I think we underestimated the amount of uncertainty that was being generated by the election and how that was holding people back. The Fed just published yesterday their financial stability report, which they publish twice a year. And part of that, they go out and they survey market participants. What are the things you're most worried about? And the number one thing was the U.S. election. It wasn't the recession and corporate stress. It wasn't fiscal stimulus. It wasn't second wave. It was the U.S. election. And we all know what uncertainty does, right? It stops you from doing stuff. It depresses capex. It depresses earnings. We've now got that out of the way. And the other thing I would say, just related to that, this has really delayed this sort of year-end reallocation into what I think is a very strong year. I mean, November, December historically are the strongest months for the S&P 500. Over the last sort of 70 years or so. I mean, your average market move November, December is nearly 1.4%, and that's people sort of anticipating the sort of year ahead. And we're sort of a little bit late to that because we're all talking about the election politics rather than thinking about what's going to happen next year. So I think now that we're through that, we're focusing on, what I think is a pretty big growth recovery next year, 30% earnings growth, 5% GDP growth. And I think, investors are too cautious looking into that. And that's going to force this reallocation and force markets up.
Ben, so on the earnings growth, I was reading some of your stuff yesterday, and I know you're forecasting, and this is a global thing, right? So you have places like Brazil, which you have earnings going up dramatically, and obviously U.S. and Europe, and it's obviously off a low. But do you think PE multiples and valuations have already anticipated this big earnings growth next year, or do you think we still have room for expansion, or do the earnings catch up to the valuation?
Yeah, so we've got we've got a couple of charts in here that sort of touch on that. There's maybe we can maybe go to the chart on valuation. I can sort of deal with that first. Valuations are really high, right? I mean, so the light blue line is your S&P 500 12-month forward PE, right? It's something like 22 times. That's a pretty dramatic chart. I guess my point would be look at that sort of dark blue line, and the dark blue line is our sort of Tower Hudson fair value PE. And so what's that got in it? It's got bond yields, which are obviously very low. It's got forecast ROE, which is still quite high. And we might want to talk about that later, just in sort of how stock markets are not economies. And sort of long-term outlook, right? I mean, this is going to be a pretty short, sharp recession, right? I think it's not going to be a very long recession, which is necessarily going to drag down sort of long-term earnings. So my point is, I think valuations are high, but they are very well supported. And there's also sort of different ways, to look at this, right? Even with the move up in bond yields we saw yesterday, they're still nearly halved year to date. If you look at your inverse of the bond yield, your sort of bond PE, it's over 100 times, right? And you compare that to the 22 times the S&P 500. Dividend yields in the US are above bond yields, basically almost for the first time ever. And that's even after all the dividend cuts that you've seen. And but it's not just about low bond yields, right? I mean, that's clearly a big part of it, but it's not just low bond yields. I mean, this sort of short, sharp recession that we're coming into, the fact that it's sort of self-induced, the fact that you've got a huge amount of policy support and it's come sort of very quickly. And I think, that's really means that, this is going to be a short, sharp recession, but also when we come out of it, I think we're going to come out of it back to sort of a trend level of growth, which is not going to be dramatically different to what we had coming into the recession. So, just under sort of 2%. I mean, not dramatically lower than that. I'm certainly not expecting PEs to go higher. I mean, they're probably going to come down a little bit. So I think earnings is really going to have to do the heavy lifting. But we do have 30% earnings growth penciled in for next year, and earnings expectations are just continuing to rise, and we're coming off sort of our second, really huge quarter actually in terms of reporting. Just historic high levels of beat. So valuations are high, but I think they're well supported. But the focus is really on that sort of incremental earnings recovery from here.
Okay, yeah, and so just diving into that, so going back to the macro a little bit. So you're looking for GDP at 5%. Goldman and some of the others are looking at 6%. We've seen sort of rates start to go up. The Fed has a inflation bar of 2%. But if you're right, and if Goldman Sachs is right, and all the others are right, and we know that that's never the case, but if everyone's right about GDP having a big snapback, and this is global GDP, right? So, 6%, 5%, whatever the number is, inflation expectations are going to blow through this 2% level that the Fed has. So the risk of potentially of interest rates going up, is that something that you're factoring in, or if you're not, why do you think that we're going to have this benign sort of situation even with rising GDP and consequently rising inflation?
Right. So as you say, the 5% number is a global number. The US is sort of 3.5 or so, which is still a great number. And in a normal environment would probably be inflationary. It's not going to be particularly inflationary this time round. Certainly not for next year, right? I mean, inflation expectations, inflation break-evens have definitely been rising, but they're still well below the 2% Fed target. You've still got a huge output gap. So really, that 3.5% bounce back next year is going to begin to eat into that, but there's no way is it going to close that. And the other thing is just the velocity of money. We've had this massive fiscal stimulus, we've had massive monetary stimulus, but the velocity of money's collapsed. And really, that's what really holding inflation sort of back at this point. That's not to say market expectations aren't beginning to move, right? We've had a big, move up in bond yields in the last in the last few days. Inflation break-evens are beginning to move up. Short-term expectations, the market is now beginning to think, could the Fed start raising rates next year? I mean, I think all that's a little bit premature. That's not to say I'm not worried. One of the risks out there is that bond yields just keep going up, and that sort of that tightens policy, and it sort of derails this sort of incipient recovery. I don't think in the way there yet, but I'm definitely sort of sensitive to that. I mean, ultimately, I think the Fed steps in before that sort of gets out of control, and we get some sort of version of sort of Operation Twist, where they sort of buy more at the long end of the curve, or you get some, or maybe more dramatically, you get some sort of Japanese style sort of yield curve control. I mean, that's still out there in the policy toolkit if this sort of steepening bond yields and a higher 10 or 30-year yields continue to move up, because that's definitely a concern. But right now, I think, as I say, bond yields have still halved from where we were coming into the year. But your point is well taken, but I think it's a bit premature.
So, so we talking about going back to sort of the valuation question in terms of fair value PEs. Looking around the world, I mean, the U.S. compared to Europe, compared to Asia, bond yields, PEs. Talk about sort of people's expectations, and or maybe what you're saying is people have to get used to higher valuations. So how do you see valuations here?
Yeah, so I think there's two moving parts here. I think valuations are clearly going to be somewhat higher than they have been sort of historically. So I think when we compare current levels versus long-term averages, I think that's a mistake. I think again primarily because bond yields are lower, but also because I think profitability has been a lot less impaired than people think, and that's again, the stock markets are not economies, right? The stock market is very long tech. Relative to the economy, it's very short financials, it's very short real estate, it's very short small cap, it's very short a lot of these segments that have been particularly impacted in this crisis. So when you look at earnings, roughly speaking, 2/3 of the S&P 500 is relatively unimpacted or relatively defensive in this environment, and 1/3 has its earnings essentially completely obliterated. And that's been the story so far. It switches a little bit now, right? Because if we're moving into an environment where GDP is beginning to bounce back and we're going to get a vaccine and lockdowns are coming down, then where do you get the earnings leverage? Where are earnings going to recover the most? It's coming from that 1/3. So I think that's the sort of genesis of this sort of rotation trade, which we're in, and I'm sure we'll sort of talk about. Beginning to lighten up on that sort of 2/3 and begin to focus a little bit more on that 1/3. But just to throw some numbers at you, I mean, the other element here is, we always get too bearish, right? We always cut estimates, whether they're GDP estimates or earnings estimates, too much, and we've seen that. I don't think it's any surprise that second quarter earnings in the US were, historic beats, and it's probably not a surprise that third quarter earnings are, not far behind, right? We're going to get sort of earnings down 7 or 8% this quarter in the US. That's a miss by 20 percentage points, right? I mean, it's absolutely enormous. So I look at 12-month forward earnings. The trough was -5%. I mean, this is global earnings. The trough was -5% back in April. Now we're up at sort of nearly 20%, and expectations continue to rise, right? I mean, PMIs, global PMIs are very expansionary. Economic surprise indices are still very high. We're coming off a good third quarter earnings season. That's not to say there aren't risks out there, but there's quite a lot of momentum behind earnings expectations continuing to rise. Being led by cyclicals, because essentially they're coming off no earnings, so that's where the margins were sort of most depressed and revenues were most depressed. But it's really across the board. Even healthcare and tech and some of these sectors which have held up very well. They're also seeing earnings expectations rising.
Yeah, and with the announcement of the vaccine, obviously a lot of people talking about going on vacation again in 2021. So given that, is there a possibility that this GDP number for the U.S., let's say, and also globally could be low? Maybe it's the first time that people. I mean, is that a possibility? Because if people start coming back and start doing things and they just they've been saving a lot of money, so there's a lot of cash in the system. How do you think about GDP being too low, and could it be higher?
Yeah, it's certainly possible, right? I mean, I don't want to get too far ahead on the vaccine thing, right? We've had, you know, we've had one announcement, right? And you've still got to prove this up. You've still got to get it, approved by the FDA. You've still got to get it distributed. People have to take it. We have a very long way to go. But I think what's important here is, we're beginning to sort of see that runway. And, what put us into recession is not the virus per se. It was fear of the virus. It was fear of what the virus was going to do to us. So I think that's the importance of the sort of vaccine. It sort of begins to sort of lift that fear. Point one. Point two, and this sort of ties in a little bit to the sort of second wave we're seeing and what that means, and et cetera, is we've adjusted to this in many ways, which is why I think these sort of second lockdowns we're seeing in Europe are going to be have a fraction of the economic impact that the sort of first ones did. I mean, we've got more stimulus in place. Behaviors have adjusted. Those people that have jobs, which is still the majority of people, the savings rate, the savings rates have doubled. So people have sort of saved for a rainy day, and as confidence maybe begins to improve and we get more visibility on the vaccine, those lockdowns may begin to ease, and they're still pretty high. I mean, a global sort of lockdown index, which by definition was 0 back in sort of January, peaked at sort of 80. Now, it's still close to sort of, high 50s. So, there's still quite a lot of restrictions out there. It still has quite a long way to go. People have sort of, more savings, which they precautionary savings, which they could spend. So it's definitely it's definitely a risk. I definitely see more upside risk than downside risk, for sure. I mean, we talk a lot about sort of fiscal stimulus and everything else. I mean, there's debate about whether we need it. My short answer is, if we really do need it, the politicians are going to deliver it, right? I mean, and we can debate whether it's $1 trillion or more. I mean, the numbers we get sort of very blasé about what are very, very large numbers, right? Even $1 trillion, which maybe the market thinks is disappointing, is still 5% of US GDP. I think it's going to be there if we really need it. But right now, to your point, I think the surprise has just been how resilient this recovery has been so far, right? I mean, we had a manufacturing PMI in the US of close to 60 last week. I mean, these are very, very strong numbers. When we've got virus cases of 120,000 in the US.
So Ben, let's switch to something that I know that something is a key part of your strategy and what you look at is investor sentiment. So, talk to me about where was investor sentiment a few months ago, where it is today. How you maybe you want to talk about how you use these indicators and what you're seeing, what factors you're seeing on the sentiment is contributing to your views. And I'll switch to
right. Yeah, so we got a chart on that because, as you say, we track this quite closely as a contrarian indicator, right? When people are super bearish, we sort of want to become bullish because that's your incremental buyer in the market. When people are super bullish, we sort of want to lean back a little bit, right? So, because there is no incremental buyer. So, the chart you see there, the dark blue line is a sort of composite sentiment indicator that we put together. And again, we use it as a sort of contrarian indicator. But it's got 4 things in it. It's got fund flows. It's got the VIX. It's got retail investor sentiment. We use the American Association of Individual Investors because they've been running that for a very long time, and the put-call ratio. So we put all that together. And basically, when you go below that sort of dotted line at the bottom, that's just a big contrarian buy indicator. And that sort of got us back into the market sort of, March, April, where it felt like a absolutely terrible thing to do. But, I guess the other use of this is it gives you a little bit of confidence to do what feels like a terrible thing to do at the time. But I guess what's surprising about this is, we're 7 months into this rally, right? We've rallied over 50% off the bottom. We're back to our all-time highs, and sentiment is still pretty negative, right? It's not sending that dramatic contrarian buy signal that it did back in April, but it hasn't improved that much. I mean, you've had $100 billion of US equity outflows since the low. You've had the VIX is still at 25. I mean, it's still way above sort of long-term average level. And individual investors, in about a third of them are bullish, which is your long-term average. But again, it's taken us 7 months to get back there. So, again, we're not at the extremes, but this is sort of interesting, again, in the context of looking forward to 2021. having just come through the election, having cleared that uncertainty into the sort of rearview mirror, we're now looking at 2021, where we're going to get, some version of lots of GDP growth and lots of earnings growth, and investors are too cautious coming into that. And then over and above that, I would also say they probably own the wrong things, right? Because if you're cautious to market, you're probably not long cyclicals at the same time. So this is all part, I think, of this sort of the ingredients of this the ingredients of this repositioning for 2021, which I think involves owning more equities. And then within that, this repositioning in terms of just holding more risk within that portfolio and owning more cyclicals and sort of less defensives and less tech.
So one of the other sentiment indicators that many investors look at is the participation of individuals, participation of retail. So obviously you've got this Robin Hood effect. You've got, that's in the headlines. There's a perception that there's all these people buying stocks and they're driving the rallies and they're moving, they're moving small caps, large caps. They can buy, they can buy pieces of Apple with only $100. So all of these things, and you see all these. This talk of individuals in the markets, which historically has been a red flag. What are your indicators showing with these type of factors?
The short answer is we don't see it, right? As I say, we look at the AA survey, which is maybe back at long-term average levels, having been depressed for a very long time. Ameritrade have a sort of similar indicator, which is back at sort of long-term average levels. Even Robinhood, I mean, they used to publish all this data until maybe 6 weeks ago. But when they stopped, the level of retail participation on their platform was basically at the lowest level it'd been since since the crisis began. So there's definitely more participation. There's been more participation year to date, but I'm not sure it certainly hasn't been driving the rally, because you then go and you look at what these investors own. They don't own the top 10 stocks. They actually own a lot more cyclicals, and they tend to own small caps. The participation of the sort of top 10 stocks is actually very low. I mean, they own Apple and Amazon and that's sort of, or Microsoft, and that's about it. So there's definitely more of them in the market, but they definitely haven't been driving the rally per se.
Okay, that's fair. So let's talk some specifics. So talk a bit about your how you're looking allocations and some of the key calls you have, maybe country sectors.
Right.
So make it a global perspective. What are you looking for, and where should we be positioning our money from a top-down perspective?
Right. So I just diverge for 30 seconds just to tell you how we what our framework is for the world. And there's a chart up here in front of you. This is actually US sectors, but the methodology is the same for everything. Basically, we're looking for out of favor assets with positive fundamentals. And we sort of capture that on this chart. So the horizontal axis, we look at sentiments. So the further you are to the left, the more out of favor you are when we look at fund flows, when we look at sell-side recommendations, when we look at valuation, re-rating, de-rating. And then the vertical axis is sort of the fundamentals. So the further you are up, the better the sort of fundamentals are. We look at your sort of leverage to business cycle, earnings revisions, and sort of price momentum. So it's a framework. It's not a quant model. We override it all the time. But the place to be is that sort of top right quadrant. That's your buy quadrant. The top left quadrant is the buy quadrant. Top right is sort of momentum quadrant. I mean, decent place to be, but got to be a little bit sensitive. You don't lose some momentum, fall into that bottom right quadrant, which is your sell quadrant, and then the bottom left is sort of value trap quadrant. But got to be a little bit sensitive. You start moving up into the buy quadrant. So that's how we sort of think about the world. Whilst we've got US sectors here, I mean, there's not a lot in the top left quadrant, and this goes for frankly all the all of these charts. I mean, staples are there, financials are sort of borderline, but there's also not a lot in the bottom right sell quadrant. So this is it's a very bifurcated market. What's in favor is very in favor, and what's out of favor is very out of favor, right? So this is essentially, that top right is basically full of tech, and now has some sort of cyclicals in it. I mean, capital goods are in there, autos are in there, and the bottom left is full of of things like telecoms and utilities and financials. Were in there, and until recently, farmers moved in there, energy's in there. So it's just a very sort of bifurcated market. And now I think you're beginning to see the switch. So what do we own? I mean, we've been running a sort of broad barbell We still have quite a lot of these sort of longer duration sort of growth plays. If you go to the next slide, you can see our a summary of our sort of country and sector allocations. There you go, just at the bottom there. We still like the US, we still like tech, we still like healthcare. I mean, these are sort of structural growth stories, and they may underperform or lag for a little bit here, but I think you've got very good balance sheets, you've got very good structural growth. I mean, the vaccines are just going to take some time to come through, but we've definitely been shifting, lightening up in those and focusing a lot more on cyclicals. So small caps, industrials, Canada, European financials, in anticipation of, what I think is now beginning, right? We've moved through the election, we're beginning to get more visibility on vaccine, and we're beginning to focus more on this 2021 sort of growth story. Industrials, real estate, consumer durables, small caps. I mean, we certainly don't own all cyclicals at this point, but those would be our sort of favored ones where I think the risk reward just makes the most sense. And again, it's where we're seeing the strongest sort of earnings revisions. And also, I would maybe just shout out, because it's not here. I mean, we have what we call a reopening basket, where basically we looked at the 15 large caps in the US, which have historically performed best on the days that you get positive vaccine news. And we've had 5 or 6 of those days before now, right? So we worked at what performed best and what performed worst. That gave us our reopening basket, and it gave us our work from home basket. Boeing, Norwegian, Marriott is all in the reopening basket, and the work from home is Amazon, Slack, Peloton, sort of those types of ideas. And and this is sort of the tip of the spear, right? I mean, and you can't just go out and buy an ETF that incorporates all this, unfortunately. I mean, there's a work from home ETF, but there's not a reopening ETF. What's interesting when you look at those two baskets is just even after the sort of rally and all the euphoria yesterday, that reopening basket has still underperformed the work from home basket by something like 90 percentage points so far this year. So it's been absolutely dramatic. These companies don't make any money, right? So the operating leverage, if you like, is dramatic. Revenues are down. In the least bad case, revenues are down 30%, and in the worst case, they're down over 100 if you're a cruise line. And you compare that to sort of retail spending in the US, which is basically back to sort of January levels, and you're 3 to 4 times cheaper on a price to book basis. My point is, I think this rotation has barely begun, and there's a very long way to go. And I think you see it more in the reopening basket outperforming than necessarily you do in the sort of work from home basket. I mean, the work from home basket is not going to collapse, right? I mean, I think these are still. This is going to take time to play out. We're not all going to stop using Zoom, even when we've all been inoculated. I just wanted to talk about the reopening basket, because that's where I think you get, that's where this sort of cyclical trade really meets the road, right? Because these are the most depressed stocks, the most impacted stocks, and I think that that potential outperformance is really only just beginning and has a very long way to run here.
Ben, given what you're talking about in terms of global growth, cyclicals, small caps, 2 things. First, so give us. I mean, we have a lot of EM people. Give us your opinion of emerging markets. Obviously, emerging markets is a broad statement, because China now represents 40 some odd. But so let's say separate China and look at emerging markets. Typically, if you have strong global growth, you have a weakening dollar, which we're beginning to see. I don't know if that's going to continue. Cyclicals, commodities. Give me your sort of opinion of EM, and maybe in particular what regions or countries of EM you would sort of look at as a potential for also to allocate assets.
So it's interesting. I look at it through exactly this sort of structural versus cyclical lens that we look at the rest of the sort of world in, right? So to your point, in my mind, 65% of EM is very structural, right? It's China, North Asia, Korea, Taiwan. China, as you know, is basically the only major country in the world to have earnings growth and GDP growth this year. They all benefit from this sort of first in, first out trajectory on the crisis. They have more tech than the US has. So really sort of very similar, very structural. They've all outperformed. They've all done very well. I think the story over the next 12 months is you begin to lighten up on that, but don't sell out of it entirely, because I think, again, you still have this sort of structural story, and especially China. I think it's still very under-owned. It's still very cheap. But the rest of EM is the opposite. It's a very cyclical story. And it's much more similar to the sort of reopening basket characteristics, right? It's done much worse. Underlying valuations are much cheaper. Earnings much more depressed. And to your point, you're much more sensitive to that incremental recovery data point from here. You're more sensitive to the weaker dollar. More sensitive to higher commodity prices. Just to put one number through you. I mean, you mentioned Brazil. 12-month forward earnings growth for Brazil is 112%. Right, it's the highest of any major market in the world that we look at. So very similar to what we're seeing in the rest of the world. I think you need to be thinking about making that tilt from those sort of structural stories, which in the EM context is sort of China and North Asia, which have done very well, into sort of more cyclicals. Again, don't sell out entirely, but begin to look at those sort of more cyclical bits of EM, the sort of Brazils of the world, and where does the sort of risk reward make most sense.
Great, Ben. Give the audience sort of how they can get in touch with you. Do you have a Twitter? Do you on your website? And talk a little bit about, maybe want to mention a few minutes about Tower Hudson in general and how people get in touch with you and sort of look at your work.
Yeah, so I mean, Tower Hudson's an independent investment strategy firm. We publish. I mean, the main thing we do is we publish a daily investment report. It's called The Eye on the World. Tracks 25, 30 countries and sectors globally, has our views, our country, sector, and thematic recommendations. You can find us on the website, towerhudson.com. You can sign up to receive the research for free for a couple of weeks. And if we make any sense, come and have a look and consume on a more regular basis. We'd love to have you.
I personally highly recommend it. So Ben, thanks again for coming on with us, and it was very informative. And I wish you stay safe. Obviously, you're in London, and I know you're in lockdown right now. But again, thanks again for taking the time.
Thanks, Tom. Thanks, Miguel and Yates, for having me, and for everyone for listening in. Have a good day.
All right. Cheers.